Welcome back, and you're watching Closing Trades here on ET Now. And let me bring on board Unmesh Sharma, who's head of research, HDFC Securities, joining us this afternoon. Unmesh, very good afternoon. Earnings season at close now. Your assessment, first off, opening thoughts.
So, we are in the process of actually publishing a report on this. So,
Sure.
at this point in time, it's a little difficult for me to comment because of some compliance reasons on that. So,
Okay, so we'll wait for that to come through.
yeah.
But overall, Unmesh, anything that stood out for you in terms of earnings in Q4? Any commentary or any numbers which kind of were either well above what you were penciling in or well below?
No, I think what was most interesting is to actually note what was happening in terms of the macro commentary. And I think that what everyone actually, even in the market, was looking out as what happens in the following quarter. And on that, I think the two things which seemed to kind of stand out most importantly were one, that there was some serious concern about the monsoon. And the other is on the second order inflation effects. So the one conclusion I would draw is that the worst of what is going to happen on the inflation is still not set into the earnings numbers. So what will be interesting to see is actually how much the earnings get impacted further as we move forward into the quarter which ends in June.
Be a pass-through of raw material costs, but that won't be followed by a pass-through to finished product. Is that how you're seeing this?
Yeah, so look, there is definitely some amount of pricing power which is sitting there with the large brands, which is why you would see that on consumer staples, we've also softened our stand. But if you look at the second order derivative, and I think this is consistent across large and small companies, that if this continues, then given the fact that oil price, as in oil product price increases have only happened now, the consumer wallet starts to shrink at the margin, which effectively means that the pricing power, both at an aggregate level and at a smaller company level, actually starts to reduce through the quarter. So I guess what we are trying to analyze right now, which we should be able to publish in our report, hopefully in the next week, is really where we will see the greatest impact uh, on the margins. And hopefully, while there are expectations of weak monsoon, if that actually starts to normalize, then hopefully there will not be a second hit in the second quarter of the year.
Interesting. And what's the take with regard to the valuations we currently sit at for the Nifty with all of these risks, looking 1 year forward at valuations? How are we sitting in your opinion?
So, look, two things. One is that luckily, because of the fact that we have had one more quarter go through, and at the same point in time, markets have been very soft. In combination, finally, we have come to around the mean levels of where we were from a 20-year perspective. So, while the last 10-year history of PE is around 20, at this point in time, we are closer to the longer term average of around 18, 18.5. The key to monitorable is twofold. One is that as we go closer to Diwali, people will start to look 1 year further. And so that means that, if market does nothing for 6 months, let's say, then you are actually, the comfort on valuation will increase even more. But at the same point in time, what had happened was that before we started the year, before the war, in fact, the expectation of earnings was that it will be mid-teens kind of number. I remember consensus being around 16%, while we were always a bit lower than that at 13, 14%. But I think that we are uh, likely to end the year closer to 10, 11% earnings growth. And, hopefully if things, unfortunately, if things on the monsoon, as well as what I was talking about on the elongated nature of the war in Iran, if that continues further, if we are looking at a single digit kind of earnings growth, which we are not baking in right now, but becomes a distinct possibility as we go through to the second quarter.
Then you're trading at roughly 18 times 1 year forward, Umesh.
18, a little bit over that. Yeah, a little bit above that. Yeah.
A little bit above that, yes. Okay, and if I were to, dissect a few key trends which are playing out in markets right now. One is IT. Where do you stand with regard to IT? It's the eternal debate, right?
Yeah, so look, what has happened is that I think, unfortunately, there is no simple answer to this. Are we part of the AI trade? The answer is, we are not seen at the top of the stack on that one. The second is that there are always these vacillations between the AI trade becoming very hot and then becoming very cold. And we are always on the other side of that. But at the end of the day, there is some reality to the trade. And so in a longer term perspective, the concern that, the Indian IT sector kind of will lag as far as valuations are concerned is quite real. Having said that, what has happened over a period of last 1.5 years is that the valuations have come finally to a point at which they start looking very, very interesting. So a lot of these stocks, if you look at the largest ones, for example, HCL, Infosys, TCS, all of these have come to numbers well below 20, and that makes it very interesting. So from that perspective, these are value buys. We have consistently been holding a negative view on IT as far as our model portfolio is concerned. In the last quarter or so, we have moved to an equal weight, which is a significant upgrade, honestly, from the place where we are. So I think tactically, what one should do is that build some position, meaningful position in this space. In the Nifty, the weight is around 11%. You could go around that in your portfolio as and when opportunities are there in the next month or so.
What are the other pockets which are looking interesting to you? So IT clearly is something where you can deploy 11% of capital if you sit on cash, viewers, or then you have to liquidate and put that. But Unmesh, what are the other pockets that are looking interesting?
Look, financials continue to look good. We believe that large banks will continue to do well. Some of the PSU names are also even today looking good. We have the larger ones like SBI in our portfolio. Pharma is looking all right on the domestic side. The one area where we are significantly overweight is a combination of the infra cap goods real estate bucket, where we are almost 300-400 bips overweight. And we believe that power and power utilities are the ones to watch out for. So I think on combination, while it may sound like a fairly cautious kind of a stance, but I think that's the nature of the market at this point in time. But these are also the places where we have the most amount of earning certainty and not much disruption as far as inflation related issues are concerned. So that's where we are.
I appreciate that. That's always the case, right? It's a market which will always be bottom up. You'll always find sectors where there are pockets of opportunity, and you've highlighted that quite candidly. I'll speak a little bit about energy first and try and get your view on that. There's obviously been a stupendous rally with regard to power infra and the like. It's time to be selective, I would assume, knowing you, and if so, where in fact today some of the power financiers seem to be doing well. So you spoke about financials, you spoke about power. Is power financiers the play?
So on power financials, actually, because it's okay. So our model portfolio is a fairly low churn kind of portfolio. Okay, we try and not change too much around because we prefer to play GARP to a large extent, growth at reasonable price, and play it patiently over a period of time. Now, what ends up happening is that, my experience of almost 20 years of watching power financiers is that you have to be a lot more tactical on that. From that perspective, we'd rather we leave that for people who are taking shorter term views. In the, we usually our model portfolio is skewed towards people who are taking a 12, 18-month view on the market. Now, SBI, Bank of Maharashtra, even MCX, as a quasi play on the power sector, given the fact that, now certain products have been introduced there as well, is already there in our model portfolio. What we prefer to do is play it directly through the power. The unfortunate part is that while the most exciting part of that power cycle, power kind of, ecosystem, which is the renewable space, is not very easy to invest if you're looking at it from a model portfolio perspective. So we do have NTPC and Power Grid in there. We continue to expect that, in the interim, with all the problems that are there with the oil and gas sector, and, it's not like you can switch on some of the other, capexes that easily. Even NTPC is in there. So what we have is NTPC, Power Grid, and indirect way of playing the power is already being played through the likes of the PSU banks and MCX.
Right. Unmesh, I'm going to pause this conversation for just a minute. We have a news breaking and we have... Welcome back, and you're watching Closing Trades. Unmesh Sharma still with us. Unmesh, really appreciate you standing by ever so patiently. Unmesh, the other sector, especially on Q4 earnings, which saw a bit of an impact, was some of these EMS stocks where, selectively there were cash flow issues, selectively there was execution which wasn't as strong as expected. How is that entire sector evolving in your opinion? And good time to probably nibble onto these names because they've seen a bit of a pullback in terms of stock price action.
Yeah, so we like that space. Okay, we have Sirma in our model portfolio. We also have buys on some other stocks. But what's happening with that one is that, the stocks have got priced for perfection, right? And at valuations which are quite eye-watering. So what ends up happening is that in this type of situation, all this continues very well in a nice bull market, but where you have had some concerns and then even a slight miss on that kind of multiplier takes the stocks down a lot. Longer term, are we positive? The answer is yes. Would you want to wait for better valuations? And Sirma, I think, is the one that we like. But other than that, possibly some pullbacks are required for you to be there. But structurally, we do like the space, yes.
Sirma at 64 times earnings, of course, you discount them 1 year forward. How does it play out? Probably just take us through what your expectations are.
So, look, I don't have the numbers in front of me.
Sure.
But
okay.
Relative to, that's a question probably my analyst can answer. But at the same point in time, I think relative to what the growth numbers for the next 3 years are, what we've done is that whenever we are in a situation where in these companies where valuations reach this much, we also look at what will happen on a 3-year CAGR perspective. And on that one, I thought we had the most upside left on that name.
Point taken, point taken. Probably that was too specific. Unmesh, with regard to consumer durables, that's the other pocket, which was expected to be an opportunity, still could well be. You're seeing some of those stocks buzz today as well. It's going to be El Nino conditions, which could drive some of these stocks higher, just given the demand. But essentially, you've had a year which has been a difficult year, FY26. There's been plenty of inventory stocking which has happened. How do you view the space?
So consumer durables we see as a part of the consumer discretionary bucket. Right now we have Crompton in there. That's the one that we have as an overweight. What's happening here is that we are trying to avoid anything which is very rural focused at this point in time, given that we don't know what happens to the monsoon. From an urban consumption perspective, generally we are positive on things like Crompton, Swiggy. Now, I'm not trying to compare these two as a durable, but what I'm trying to say is that in the overall bucket, if you look at mid-level kind of urban consumption, we continue to remain a lot more positive, given that that is where we expect the least amount of stress to be in case the monsoon goes bad, and even if the inflationary pressures come through. So, in that sense, we have Crompton Consumer in there, yeah.
And what about the likes of a Titan, an Interglobe, some of the Nifty names, the Nifty heavyweights, again, within the consumer discretionary basket? Would you at all consider those as well as possible good plays?
So, Titan, actually, we have left out of our model portfolio, given where valuations are. Possibly in the last quarter, we would have missed a little bit on that, but that's all right. Structurally, given where valuations are, I think it's while we don't have a negative view on the company as such, but at the same point in time, in a model portfolio, you're really looking at valuations versus other names in Nifty and what else can you have from outside that. So in that sense, it is outside. Same for Interglobe. I think the uncertainty on that one is just too much at this point in time. We'll probably revisit that. It's a very interesting one. They've had a lot of challenges, but they seem to come out of it. But at the same point in time, in this kind of environment, given where their core raw material price, basically core fuel price is globally linked, is it the right time to take a call on that? Probably not.
Unmesh, thank you so much. You've been very generous with your time. Really appreciate you coming in and speaking to us.
Thank you.
All right.